everyone, it is Evan here from thetraderisk.com, and in today's video we're going to be discussing commissions and taxes, how they're destroying your trading profits, and what you can do to mitigate the impact of these two very important factors for all traders, especially the more active traders. Now, I know it's not a sexy topic like trading strategies, indicators, entries, exits, trade management, stock selection. All of those good things are much more appealing to us as traders who like to tinker and sort of work on strategies. But I assure you that if you do not have these two elements in check, if you don't have your trading operations in check, this is one of the most costly and expensive sort of impacts on your trading account. So if you're finding this video natively on YouTube, we do have a blog post. Everything we're going to cover is up on thetraderisk.com. I will link it up right now in the top right hand corner. So if you want to scroll through the article instead, by all means do that. And in the description of this video, I'm going to put the timestamps with some of the sections we're going to be covering. So if you want to jump around, that's cool too. Just head to the description. Sometimes I go on rants and things take a little bit longer. So feel free to jump around. You can find that below. So without any further, let's jump into our lesson on commissions and taxes. Back when I just started trading, I paid Scottrade $18,364 in commissions. Now at the time, my account size was right around $25,000. So when we look at that commission cost versus the account size, we can see that I needed to return 73% on my trading that year just to break even, just to pay Scottrade the cost for trading on their platform. I ended up losing about $3,000 that year, and I thought it was me. You know, I thought I had to study more, I needed a new strategy, I needed to work on my psychology, right? These are all of the things that we are taught and we read in books as traders starting out on how to improve and how to get better. But really, I was stuck in a situation that had the odds stacked so laughably against me. There was no way that I was going to be able to turn a profit in that type of trading environment, in those operations that I was currently sort of going down the path of. I made over 60% return that year. Now, granted, most of that return was just crazy risk when I look back at it, slinging around options and doing some crazy stuff that, you know, I would just kind of want to vomit thinking about some of what was conducted the early years of trading. But the point is, it could have been a lot worse. I had a great return, all things considered. It was the cost of commissions that was really killing me. So the most overlooked but expensive cost for traders is commissions. And again, it's boring conversation for most traders, especially if you're starting out. Nobody wants to really talk about, you know, these $1, $2, $3, $4, $5 commissions. They're innocent sounding, right? How big of an issue can it be? I'm going to be the next, best stock trader in the world who's going to retire with yachts and do all this great stuff. I don't need to worry about these several dollar commissions per trade, but that's not exactly the case. So I recently consulted with a trader who was basically in an identical situation to the one I was in years ago. Looking to actively day trade, paying $7.95 per trade with an account under $20,000. There is nothing that I can teach this trader about strategy, entries, exits, indicators, anything like that is going to be more important than getting the trading operations under control. There is no way that you can be an active trader paying those types of commission costs with small accounts. So here's an example that I want to run through to sort of illustrate some of the impact here, and maybe you can relate to this if you're starting out or as you think about your trading that you're doing right now. So I want you to meet Johnny the day trader. Johnny is super excited to start trading. He wants to be active. He wants to trade fairly frequently, And here's some of the stats that we're going to apply to Johnny here, and we're going to start to break down just a little bit of basic math to sort of illustrate the impact here. But Johnny makes 10 trades per week. So that's 20 transactions. Remember, you get to buy and sell, so that's 20 transactions, but it's 10 trades per week. And he takes partial exits on half of his trades. So now we're talking an extra 5 transactions, so we're up to 25 transactions per week. And he pays his broker $5.95 per transaction. Johnny takes 2 weeks of vacation, no trading, good for him, to get away from the screens. So that means he trades for a total of 50 weeks per year. So let's take a look at the math for Johnny's situation. 25 weekly transactions, 50 weeks in a year, so he makes a total of 1,250 annual transactions. When we apply that to the $5.95 commission costs, we can see Johnny is going to pay $7,437 out of his pocket to his broker. Still doing better than I did on my beginning year when I paid, $18,000 and change. But here's the table to pay attention to now, because most traders don't come into trading with a high, 6-figure account. Most traders are starting to earn some money on the side, and they want to invest it and trade it to actively grow it. So when we look at the account size needed to break even on $7,437, this is what Johnny's going to need. At $5,000, which is a kind of standard amount, that's, many traders start in this business with a couple $1,000, $5,000, maybe if they're lucky. You need 149% return. That's just to break even. That's before you start paying yourself a dime. You need 149% return on 5K. And you can go right down this list. 10K, 74%, 20K, 37%. $50,000, you still need a 15% return. And even a 6-figure account at 100K, you still need to earn 7% to break even. And to give you some context here, the long-term annual growth rate of the S&P 500 is about 7%. So that's how much the stock market, if you were just a buy and holder to just own the index, put it away, and not look at markets, it grows at roughly 7%, depending on how you want to account for inflation. But think of that against your trading account, because you're not growing at 7%. You're actually getting negatively compounded 7% against you year after year after year. So here is the next topic here of how do we handle this? What do we do? And it's really getting more profitable by immediately reducing your commission costs. It's very simple, but very few seem to want to do it or actually go ahead and get this accomplished. The solution is simple, right? How do you do it? You find a cheaper broker. And the good news is the year-over-year costs of trading transactions, commission costs, they're in a long-term bear market. If we look at this chart here, and it only goes to the 2000s, but I can assure you that ever since the 2000s, really, we've actually only kind of accelerated lower in costs. But you can see here, ever since the 1970s or so, we've kind of peaked out and commissions are on the decline. If you're a new trader, if you're just starting out here in the past year or two and you're kind of getting your education up to speed, commissions back in the day would cost hundreds of dollars per trade. It was nuts, right? Nothing like you see here today with $10 or less. But as we see, $10 or less still adds up if you're an active trader. So the good news here is brokers are cheaper. So thanks to Robinhood, you can even eliminate commission costs altogether. Basically Robinhood was introduced, I think in 2014 is when they went live. They have a $0 commission cost policy, and for new traders, if you're just starting out, I recommend, or I strongly suggest, no direct recommendations here, that traders dip their toes, get started with Robinhood. And the reason is because of the chart we looked at before. Think of Johnny, the day trader, who wants to start with a small amount of money and actively trade. That cannot happen with virtually any broker with a sub, say, $5,000 account. Trading several times per week basically cannot happen. Even if you're one of the most profitable traders in the world, you are still going to get eaten alive by those commissions. So Robinhood, like them or hate them, and again, they don't have all the tools, they don't have charting software, they don't have a big suite of indicators, but if you're starting out and you're trying to get market experience. You're trying to get skin in the game. You want to see how stocks move. You want to start to participate in trades and not get destroyed by commissions. I think it is financially irresponsible not to be with Robinhood as you start out. Now, as you start to get more experience and you need more tools and you need to do some other things, then you can graduate to another broker. But for pure execution standpoint, I think Robinhood is where you want to be. Now, the bottom line is, whether it's $8.95, $5.95, $2.95, whatever you're paying your broker right now, you need to think about the value that they're giving you beyond just the execution. So you need to think, is there a cheaper alternative for me to trade and transact in a cheaper fashion? Because it will drastically improve your bottom line if so. Now, again, if you're a position trader, if you're an investor, if you're not doing many trades, then I have no problem if you're paying I think it's totally reasonable to be paying $9.95 per trade. You like your broker, you've been with the platform, it does everything you need, and you make a dozen trades per year. It's water under the bridge that doesn't really, impact your bottom line all that much. I'm really speaking to either A, the traders with smaller accounts, or B, the traders that are very active or want to be very active, making intraday trades or even a trade every day can add up. So think about that. Think about the options out there. I'm not going to go through a big list or bring you a table of brokers because they're changing their offerings. If you do a quick Google search, you can certainly check out what the latest offerings are for brokers, but it's something that is absolutely worth your time every year or so to sort of refresh the options out there and make sure that you're in sort of the best situation, you have the best operations under control for your trading. So our next here, we're going to start to move into taxes and get more profitable immediately by trading in tax deferred accounts. Now, before we get into this section of the thing in the blue box there, you see the slight disclaimer there. Remember, nothing published by the Traderisk is financial advice, nor is it tax advice. So please consult a CPA, review our disclaimer, traderisk.com/disclaimer. So make sure you get your personal advice with a professional that can look at your situation. I want to just talk about some high level things to think about, some concepts. Everything here is pretty much, able to be found pretty easily through Google, and you can dig into it based on how it relates to your situation. So taxes play a potentially even greater role in destroying your trading account over time, your trading profits over time. It's tricky to speak specifics because everyone watching this is going to be from different countries, different tax brackets, income brackets, ages. There's a lot of variables in the tax structure, particularly in the US. So it's tough to talk specifics, but again, our goal here is to just kind of point you and to give you some things to think about and research for your own situation. So before we, really get started, let's put a definition to tax deferred accounts. I'm going to just read this out here. Tax deferred saving accounts occur when you use a specifically designated account or investment option that does not require you to claim the investment income earned inside of the account every year on your tax return. So instead, you get to defer this investment and income until you choose to take a withdrawal from the tax deferred savings account or until you cash in the investment. Grab that from thebalance.com. So basically, taxes in this type of account are sheltered. You don't have to report them every single year at the end of the year and pay your 20%, 30%, whatever your income tax is. You can actually kick them off into the next year and then to the next year and to the next year until you decide to take those distributions or cash those in or roll those over in some way that would trigger a taxable event. Tax deferred accounts generally fall under the category of retirement accounts because they are in place to help everyone grow in a more reliable fashion and to actually get some savings for when people are done working. So here's a chart of the impact of taxes over time. So that orange line there is a tax deferred account. That is an account that is growing year over year without any withdrawals or tax implications come the end of the year. The gray line is a taxable growth account. So this assumes that you're going to withdraw money at the end of every single year on your profits to pay your taxes, thus reducing your capital each and every December or January or whenever you would do your taxes. And for this simulation, it's a starting balance of $10,000 with a 15% annual growth rate and a 30% taxable rate. Just kind of stuck there with some round numbers. I think we can all sort of figure out where we sit relative to our returns per year and our taxable rates. But notice the huge difference here after 10, 20, 30 years. It makes a tremendous difference. And it goes without saying, obviously returns are not going to be this linear. You're not going to always have 15% returns, but it's not really the point here to illustrate a perfect, an ebb and flowing sort of reverting trading strategy. It's more just I'm more interested in showing you the impact of taxes over time, year over year, over a long time horizon. So that in itself should hopefully get the gears spinning and get you thinking about potentially looking at some other options for your trading accounts. And we're going to show you how to do it. So tax-deferred accounts, there are benefits and drawbacks. So the clear benefit is just the huge return we just saw, right? The huge growth return over a long period of time significantly boost your long-term annual growth rate. I think that's clear, and that is by and large the most positive benefit for this type of account. Another benefit is you can't touch the funds without incurring a penalty, and this is a benefit because it's going to keep you sort of saving. It's going to keep your investment money sort of where it belongs, is as an investment. And if you see if you're looking to trade in for that new car and you want to sort of tap into your trading account here, you can't quite do it. It's stuck there, and it's sort of a good behavioral sort of best practice if you're in fact trying to grow your wealth for a longer term time horizon. Really enforces discipline. So the drawbacks are there are limitations to how much you can contribute each year. You can't sort of just throw in 10 grand, take out 5 grand. You can't put in another 3. You can't just move cash in and out like you can with a normal taxable margin account or a standard broker account. There are limitations every single year on how much you can contribute to these types of accounts. And you can't supplement your day-to-day income with trading in this type of account. So, for example, if you started trading so you could help pay for your bills, if you wanted to pay the electric bill or pay the rent every single month, you're not going to be able to do it in this type of account because you can't easily withdraw from tax-deferred accounts without incurring a penalty. And if you start incurring that penalty, then you're really just going to do more damage. You might as well just keep it in a taxable account to begin with. So your funds are sort of stuck. So ultimately, in this blue box in the bottom left, allocations boil down to your goals and why you got into trading. If you want to supplement your income, if you're trying to quit your job to trade, then tax-deferred accounts, of course, are not going to be ideal for you. But if your goal is to grow your wealth and to build and compound as fast and as much as you can, then tax-deferred accounts make a ton of sense, and especially for active traders. And a little tip there is to diversify between accounts. I don't think you have to be all in. You don't have to only trade one type of account. You can have multiple sort of accounts. So you have your taxable account where you can withdraw if you need to pay the bills or get a new car, upgrade to a new iPhone. And then you also have your savings, which can start to grow without being, impacted by Uncle Sam at the end of the year. So that pretty much wraps everything up. That was the lesson for today. Beating the markets as an active investor is difficult enough to do, right? There's lots of challenges to have a long-term, consistent growth rate as traders and investors. And what we're saying here is don't make your life any harder than it has to be. Get your commission costs under control. Be strategic with your structures in which you invest your capital. And if you look there in the blue box, chances are, I've seen it time and time again, the 200 hours that you're going to go out and search YouTube for trading, optimal trading entries, or how to get my, indicator, switching the look back period so I can get a slightly more profitable trade. chances are all of that work you're going to do, and I don't mean to sound pessimistic or shoot this down, because I think those are important things to do, is to optimize your strategy. But I think many people kind of miss the forest, and they don't take 1 hour or 2 hours of research per year to make sure that they're paying as cheap as possible for their commission costs, calling up their broker and saying, hey, I've been with you for X years and I paid you X dollars last year. How about 20 cents cheaper per trade, right? And I think that is going to impact your profitability a lot more than many of these other sort of activities or research sort of fields that I see many traders spending a lot more of their time on. So if you enjoyed this lesson, check out more, traderist.com/learning-center. There's a lot more articles. There's more articles here on YouTube. So in the trading education playlist, there's a lot more. It's not just boring stuff like this. There are strategy conversations, finding stocks, all types of things, basically all things trading. But if you do like this video, check out some of the other material that we have out there. And any questions, leave a comment below, send me an email or contact through the TradeRisk website. I'd love to hear from you. So thank you so much for watching, and good luck out there.